You know when you see a stock price flash across the screen? It's up, it's down, it's all over the place. But have you ever just stopped and wondered, what is that company really worth? I mean, if you forget all the daily market noise, how do you find the actual, solid, fundamental value of a business? Well, that's exactly what we're going to dig into. Okay, so for today, we're going to be financial detectives. And this is our case. A company called La Comercial. Right now, the market is saying one share is worth $41.90. But is that the whole story? Is that the truth? Our mission is to find out if the markets got it right.
So, where do we even start? I mean, how do you pull a number out of thin air? Well, you don't. This isn't guesswork. Financial analysts have a whole toolkit of models specifically designed to answer this question. Each one looks at the company from a different angle. And today, we're going to use three of their most powerful tools.
All right, our quest begins. The very first tool we're pulling out of the bag looks at the most direct promise a company can make to its shareholders. We're talking about cold, hard cash in the form of dividends. This first method is called the dividend discount model, or DDM for short, and the logic behind it is actually pretty simple but really powerful. It says that a stock's value today is basically the sum of every single dividend payment it's ever going to make in the future. You just have to add them all up and adjust for the fact that a dollar today is worth more than a dollar 10 years from now. It's all about what future cash you're going to get and what that's worth in your pocket right now. But here's the thing. A company's life isn't one straight line, right? They don't grow at the same speed forever. That's why analysts use what's called a two-stage model. First, we'll forecast dividends for a few years of really fast, high growth. Think of it as the company's youth. Then, we calculate one single value, the terminal value, for all the dividends from that point on, when the company matures and settles into a slower, more stable growth pattern. And for our company, La Comercial, the analyst is projecting a blistering 21.7% growth for the next 3 years. Wow. But after that, things cool down to a much more sustainable 7.2% for the long haul. These two numbers, right here, are the engine that's going to drive our first valuation. So, after we project all those future dividends for both the fast and the slow periods, and we discount them all back to what they're worth today, the model spits out our very first answer. According to this DDM model, one share of La Comercial is intrinsically worth $46.91. Okay, so here's where the rubber meets the road. How does our number compare to the market's number? Our calculated value, $46.91, is almost $5 higher than the current stock price. So based on this one tool, our conclusion is that the stock appears to be undervalued. The market might be missing something here. But you know, a good analyst never, ever stops at just one answer. Dividends are just the cash a company chooses to pay out. What if we looked at all the cash the business generates before any of those decisions get made? Let's grab our next tool and get a look under the hood. And this next tool is the big one, the discounted cash flow, or DCF model. You can think of it as the DDM's bigger, more comprehensive brother. Instead of just looking at dividends, it tries to value the entire company based on all the cash it's expected to generate for everyone who has a stake in it. That means both stockholders and lenders. Whoa, okay, that looks like a monster. I get it. This is the formula for something called free cash flow to the firm. It looks really intimidating, but trust me, the idea behind it is simpler than it looks. We're just going to build it together one piece at a time. It's not as bad as it looks, I promise. So everything starts at the bottom line, net income. You know, the profit. For La Comercial, that's a really solid $2,357 million. That's our starting block. Next, we have to do something a little weird. We add back expenses that were on the income statement but didn't actually involve cash leaving the building. The best example is depreciation. It's an accounting expense, not a cash one. So we add another $1.8 billion back onto our cash pile. But of course, you gotta spend money to make money. So now we have to subtract the cash the company invested back into itself. You know, buying new equipment, building new facilities. And for La Commercial, that was a huge investment, a hefty $2.8 billion. So, after all of that, all the additions, all the subtractions, we get this.
So, after all of that, all the additions, all the subtractions, we get this. Yeah, that's a negative number. A negative $701 million. The company's investments were so huge that its free cash flow was actually negative. That's not what we expected.
And you know what? We're not the only ones who think this is weird. The analyst who actually did this work basically threw up their hands and wrote in their notes, in all caps, "This methodology is not suitable." You see, a negative cash flow basically breaks the model. It hits a dead end. So what now? The model failed? A tool in our toolkit broke? Do we just pack it in and go home? Absolutely not. A real analyst knows that sometimes a tool just isn't right for the job. So you just put that one down and you pick up another one. It's all part of the process. Okay, so if looking inside the company's cash flow didn't give us a clear answer, maybe looking outside will, it's time to play the comparison game. This is called relative valuation, and it's kind of like figuring out if your house is priced right by looking at what the other houses on your street sold for. The idea here is really straightforward. We're going to compare La Commercial's vital stats to other similar companies, and the specific metric we'll use is the price-to-book ratio. This just compares the company's stock price to its book value, which is basically what would be left over for shareholders if the company sold off everything it owned and paid off all its debts. And here it is, the showdown. La Commercial's price-to-book ratio is 1.44, but the average for its competitors, what we might call a justified PB, is way up at 7.97. That isn't a small difference. That is a massive gap. The market values its competitors almost 8 times more richly on this specific metric. So the rule of thumb is pretty clear. When the competition is trading at a much, much higher multiple than your company, it's a strong sign that your company is being overlooked by the market. In other words, it looks undervalued. And hey, that's now 2 different models pointing us in the exact same direction. Okay, we've used 3 tools. One worked great, one failed spectacularly, and one gave us a really strong clue. Now comes the hard part, the art of the whole thing. It's time to put all these puzzle pieces together and come to a final verdict.
I mean, just look at this range. We ran a few different models and got answers from $28 all the way up to $160. And this isn't a mistake. This is the reality of company valuation. It's not about finding one single magic number. It's about using these tools to build a credible range of possibilities, a sort of zone of value. But at the end of the day, an analyst has to make a call. They have to weigh the evidence. They probably threw out that crazy high number from the multiples method, and they definitely ignored the model that broke. They likely leaned heavily on the model they trusted most, like our 2-stage DDM. They used their judgment to synthesize it all into one final target price, $46.79, and that leads to a very clear recommendation: buy. So what we've seen is that valuation is so much more of an art than a pure science. It's really about telling a story with numbers. It forces you to ask the right questions. What are this company's real promises to its investors? How is it investing in its own future? And how does it stack up against the competition? So the next time you look at a stock, don't just see the price. Ask yourself, what story is it trying to tell you?